Hey everybody, welcome back to another beautiful day in real estate. Today we're going to be going over quite a bit of stuff. So we're just going to jump right in, you guys. We're not even going to go over an overview. We're just going to talk about it, okay? Interest rates again, conventional is at 6.32, FHA is at 5.89, and 5.9 for VA across the board for on average, right? Okay. We're going to talk about this for a minute because interest rates have been moving. Yesterday we saw a pretty significant downward pressure, which is good for the market, but it also makes me kind of wonder what we're going to be seeing, right? So the market always kind of prices in the future, the slight future, right? So let's talk oil for a second. I'll kind of explain. So the market heard of the ceasefire come out, right? And the market completely took a dump. Well, then there was talks of the war didn't really actually stop. They were, there were still attacks. They were still attacking Lebanon, and the market went right back up because then everybody thinks the war ends, then the war continues, and then here they came in on Monday morning and actually saw major downward pressure. No major announcements or anything like that, but it makes me kind of wonder what we're expecting. Like it did bounce off that support this morning as we opened. We opened the market here about 41 minutes ago, and it's showing kind of a support line again. Like I said, this next support really is down at 75. So, I mean, if it breaks below here and it kind of closes below $88, $87 a barrel, I think we're heading down to 75. Somebody commented on my video the other day. They said, "Oh, that's futures. That's not actual spot. This is the spot WTI crude oil versus U.S. dollars." So yes, this is crude oil, and there's a couple of different ones you can pay attention to. I pay attention to this one. It seems to be the most accurate based off of what I've seen. Anyways, that's neither here nor there. My point is right now the market isn't showing a lot of strength in oil, which means that people are pricing in, or the market's pricing in, that we're going to be optimistic that this war is going to end in Iran here sooner rather than later. I don't know if that's true or not. I mean, there's a second round of negotiations supposed to happen later on this week with JD Vance, or next week. It was within the next 2 weeks here. I'd like to see it, but I mean, really at the end of the day, yesterday we saw oil prices go down and we saw bond prices kind of tick up, and then it bounced off of this resistance now, right? So we've seen it kind of hit the resistance 1, 2. We're in that consolidation period. Like we did talk about that a couple weeks ago, that we were expecting to see it kind of break below 4.28 and consolidate between 4.19 to 4.27 for now, right? Until we see some more confident news, if that makes sense. So until the war ends, we're not going to see as many people buying bond prices. I learned that recently. I thought it was the other way around, but right now when there's uncertainty for inflation, which is caused by the war, most people are going to go into more confident markets, or they're going to put their money more confidently where they feel like they're going to be able to continue to make money, right? Anyways, so on to the next. Jobless claims came in lower than expected, which is good. I mean, actual was 207, forecasted 215, and the previous was 219. This one's an interesting one because, again, I don't really trust this news anymore. I used to think, I used to believe that every bit of data that came out was true, but they've revised it so many times between start to finish. I mean, it shows that the market's still getting stronger, right? Like the job market's getting stronger, but I mean, really, it doesn't feel stronger, right? The thing is on paper, the market is getting better, but how do people feel internally? Not very good, right? Not many people are just jazzed about this economy. I think right now, and again, until this kind of is put to bed, this war in Iran, we're just going to see a lot more uncertainty. It's going to kind of consolidate. I don't really think we're going to see major movements up or down anymore. I think we're kind of in that consolidation phase. Like I said, if we're talking the 10-year bond, which directly correlates to mortgage rates, like we've talked about, so oil goes toward, directly correlates with 10-year bonds. 10-year bonds are the basis of mortgage rates, right? You typically see about a 200 basis points or a 2% gap between the 10-year bond and the interest rates, right? So we're 4.7 here. We're at 6.38 or 3.1, excuse me, 6.31 for conventional, right? So just over 2%. But I think that there's going to be more of a consolidation more than there's going to be a big run up, right? So if we look back, there usually is going to be a consolidation. Like you can see right here, that's kind of the top, that's kind of the bottom. It consolidated from, well, basically from September of 25 all the way to March of 26, March 20th of 26, right? So consolidations are not uncommon. We kind of go up, you go down. It just kind of stays in the channel, which it did here for quite a bit of time. I think we're going to be in a smaller channel because it's going to be quicker moves for now. Who knows? It might break below here, and we might just consolidate between 3.97 and the 4.27 range again. But right now it's kind of all up in the air. We don't really know exactly what to expect. But Pete Hegseth, announces that the U.S. will launch Operation Economic Fury on Iran. So what we're hearing in the United States is that the war is almost over. They have Iran on a submittal move, and there's no way they can rebuttal. There's no way they're going to win the war. Again, I think I'd like to believe that we're almost to the end of this, but I just don't see it yet. I mean, maybe I'm just pessimistic on that side of things. I'm just tired of seeing a bunch of bullshit get posted all the time. But my guess is that we're going to be seeing some more negative news coming out of Iran in the next few months. And this right here, just stating that we're going to be seeing Economic Fury, Operation Economic Fury. They're going to try and crush their economic system, where the United States is blocking the Strait of Hormuz. So basically take control of that and only letting through ships, countries, and companies that they want to, that pay a toll. I don't know if they're going to charge a toll, but they've kind of hinted at it. But anyhow, this is putting pressure on more countries. For if you're talking Australia, you're talking petrol, or you're talking gas, right? You're talking, this one was the IEA announces Europe just 6 weeks worth of jet fuel remaining in the Iran war shortages worsen. IEA also says that many flights may soon be canceled as a result. Jet fuel prices in Europe soared over 100% amid the war. That's what people aren't paying attention to. People just think that oil is, I shouldn't say people. Oil affects all sectors, right? And when you cut off 40% of the oil supply, you start to really strangle a bunch of economies, not just the United States, not just Australia, not just Russia and China. You're cutting off to the whole world. And that is causing oil prices to go up, causing gas prices to go up, causing food prices to go up, because again, your food is transported by what? By trucks, right? So even if it comes from a boat, which needs fuel to float, right? Or to move, to go from point A to point B, the same thing with a semi truck when it picks up that food, right? So if gas prices are 100% or a 40% increase, companies don't eat that. They pass that along to the product, which the product goes to the consumer, which the consumer is you, right? So until this war ends and we don't see this shortage, I think the next pandemic, and my mentor brought it up, is going to be an affordability pandemic. It makes sense to me. I mean, things are a lot more expensive than they were a few years ago. Housing is insanely higher than it was before. Somebody did comment on that. They said that the housing market's going to crash. But again, there's nothing stating that the market's going to crash other than the prices are too high. Okay, I understand prices are high, but we also printed double our debt in 2 years. Like, of course, houses are going to be worth more because the dollar's worth less, right? That doesn't mean that the market's going to crash, right? We aren't seeing significant inventory. We're not seeing an insane amount of foreclosures. We're not seeing defaults. We're not seeing foreclosures. Like I said, and I think I read the statistic. What was like 40% of homeowners own their homes outright right now. Like, yeah, dude, don't get me wrong. The younger people are having a problem getting into the home, but they're still selling. There's just not a lot of pressure. Again, if the market crashes, it's not going to be real estate. It's going to be private credit. It's going to be credit cards. It's going to be the auto loan debt. It's going to be something like this, where they suffocate the ability to transfer oil or something across the world, where we create a pandemic or a famine in some senses, right? So here's what I'm kind of leaning into next: the buy now, pay later crisis. Again, it's a credit-based, debt-based conversation, not a real estate conversation, right? 40% of buy now, pay later users were late in paying their BNPL, buy now, pay later loans over the last year. Dude, you can buy anything now and pay later. Literally, I've seen anything from Amazon product to TVs and Best Buy to, dude, they're bringing out the layaway system, but way worse. And a lot of people are not paying them back because they don't have the money to pay them back. So like people are borrowing and leveraging against their future selves or paying interest on a product, right? There's those companies. They used to be the cash now locations or whatever they are, where you basically can take an advance on your paycheck and then your paycheck goes there, you lose a percentage, etc. The percentage has risen 6 points from 2025 levels and 13 points over the last 2 years. High income borrowers, young adults, men, parents, and young kids among the most likely to miss payments. This comes as 25% of borrowers now hold 3 or more active buy now, pay later loans at once, driven by Gen Z and millennials. Furthermore, 29% of users are turning to these loans for groceries and 20% for restaurant delivery or takeout. This one's a tough one, dude, because don't get me wrong, I make the mistake of ordering food more than I should. Granted, I'm working 70 hours a week. My wife and I are kind of, we hit it some days where we're just like, you know what, I don't want to cook. Let's get some food. Let's do the thing. But dude, people don't realize how much money they're spending on just delivery and takeout, man. Like, I am well aware of what it costs me to go for food, and I do not like it. But again, sometimes I pay for convenience. We do well enough where I can pay for that convenience, but a lot of people don't have that capability to pay for convenience, right? They pay $40 for food, right, to get delivered, and then they pay $10 for it to be delivered, so they're $50 deep. If you're doing that for 2 meals a day, that's $100 a day, right? You're doing 2 meals a day, 5 days a week, we'll say, just on the conservative side, right? So now you're spending $1,000 a week on food. I'm sorry, $500 a week on food. My math is not math. So you're paying almost $2,000 a month just on delivery and takeout. Like, yeah, of course you don't have money. Like, people complain about how expensive everything is, and don't get me wrong, it is. But I mean, I also used to work for a job that made me less than $15 an hour, and I was still making it work. Granted, it's a little bit different world, but dude, you just don't go out to eat. You don't go out to eat. You don't go buy expensive clothes. You buy the cheap ass thrift store clothes. Like, you go to TJ Maxx, you go to Walmart, you get the cheap brands. You go to the store, you buy. I mean, you buy whatever you can to kind of make ends meet and save a penny, save $1, right? But everybody thinks they deserve all this stuff. But anyways, I mean, the transactions, it says, we'll finish this up. Transactions using for buy now, pay later loans are expected to surge 687 million in volume by 2028 from the 334 in 2024. So they're saying it's basically going to double over the next few years. Americans are increasingly fighting inflation with more debt. You guys, this is the crash that we need to be paying attention to. Over leveraging stuff that's not a house. A house, again, is my housing market is the least of my concern right now. I don't care that there's a 600,000 more sellers versus buyers. Again, depending on the market you're in, right? If you're in North Dakota, the market has got no inventory, zero, zitch, zada, nana, right? None. You go to New York, you do to Florida, you go to Texas, you go to California, you go to Washington. Inventory is different. Different markets, different things. But it's the loan issues that are going to cause a major issue, right? Major problems, which leads to my next, which is going to be talking about the U.S. federal debt has never been higher. In the first 6 months, fiscal year 2025, interest expense jumped 7% year over year, to $623 billion, the highest in the for this period in history. This is even higher than during the massive pandemic response of 2021, when the budget deficit was 1.7 trillion. Over the last 12 months, gross interest expense is running at a record 1.3 trillion. As a result, interest is now the second largest spending category over the Social Security at 1.6. Interest expenditures are $300 billion larger than healthcare spending and $400 billion larger than defense spending. The U.S. debt crisis is in full swing. When we keep borrowing money, our debt becomes more and more costly, right? So here's what we got to be doing. Here's what we can do. Well, first off, we need to see some different stuff. Like, we need to see somebody behind the wheel that's really going to make a difference, and he's going to help make people feel confident again. And unfortunately, our government's just not going to do that, right? So it's important for us to understand what we have the opportunity and the obligation to do here as homeowners, as investors, and as the middle class. Because there is a fact here that at the end that I'm going to talk about. And, you know, we'll just jump on that right now. This is kind of nuts to me, okay? The U.S. economy is becoming increasingly K-shaped, meaning that the top 20% of earners, those making more than 175 grand a year, are now up to nearly 60% of total US personal spending in data going back to 1989. In effect, the bottom 80% of earners represent 41% of spending, the lowest share in the last 35 years. So you were in the top 20% if you make over $175,000 a year. That's insane to me. That's insane to me. Dude, like, don't get me wrong, 175 grand is a decent amount in a year. But that's only 20%. Like, that's 20% of people are at that. So that means 80% of people are making less than that in the United States. No wonder they're struggling, man. Like, it is a hard world out there. Most age divergence occurred during two distinct periods, the late 1990s dot-com boom and the post-pandemic market rally. Both periods characterized in a surging of stock prices that disappropriately lifted the wealth of the higher income households. As a remainder, consumer spending makes 68% of US GDP, meaning the wealthiest 20% of Americans now effectively drive more than 40% of the entire economy. This creates a fragile dependence on the stock market's performance to sustain growth. An economy fueled by a small group of wealthy households is one market condition away from stalling. So what it's saying is the majority of people, I think there's only 10% owns 90% of the stock market, 10% of the people, right? So the top earners, because the lower earners don't feel like they have money to invest. The problem is it is on a crutch right now, and that crutch is about to break. Just because we're seeing new all-time highs in the S&P does not mean they're going to continue to go. The S&P it's running on fumes, and it's going to fall off a cliff. It will fall off a cliff. Again, that concerns me more than real estate concerns me, right? I want to get into something that's not artificially propped up, and right now, real estate isn't artificially propped up. If anything, it's holding pretty resilient for the market that we're currently in, and people are going to be talking about side-by-side comparisons for 2008. We've been over that. That's different, right? 1 million MLS listings versus 4 million in 2008, right? 2.8 million foreclosures versus, I don't know, it was like 340,000 foreclosures. Like, we're not even close to the same perspective. We're not nearly as close to any of what 2008 was. But we are factoring in right now issues of debt, right? So last thing I'll touch on, the private credit crisis is unfolding at record speed. Investors requested 14 billion in redemptions in Q1 of 26, and only 50% were met. So that means that $7 billion of taxpayer money or investment money is held up and not being able to be pulled. So that's a big problem, and we've talked about that before. That the reason they can't pay it out because they don't have the money on their books to pay it out. They leverage that money. The problem that I'm going to see here is that they are willing to leverage your 401ks, your pensions. You guys are the ones that are holding the bag. Banks and investment firms aren't. That's the difference between 2008 and now. In 2008, they passed the bag along to banks. Banks are the primary issue, right? BlackRock comes in, bails them out. We're back to the races. We go on a bull run for the next 20 years, right? I don't know, 18 years, 17 years, whatever it was. 12, 14. Anyway, now we look at this crisis side by side from 2008 to 2026 because it's the most recent financial crisis, right? And the big thing that stuck out to me is it's not the banks holding the bag, it's the investor, and it's the small fish that's holding the bag. It's just a lot more small fish. So what could happen is we're going to see this credit crisis, private credit crises, continue, and the cracks are going to get bigger. We're going to see the barrier is going to blow, and the people holding the bag are not going to be the banks. It's going to be you. That's why I get so concerned about the market, not real estate, but because right now all of the money that's invested in paper-backed stocks and paper-backed investments are the ones that are inflated, overpriced, and they're going to cost you so much money when they implode. So again, focus on getting into real estate rather than putting money in the stock market, because the stock market isn't going to be held up forever. The real estate market isn't either, but at least there's a physical asset that you can continue to build wealth on over a 5-year period, 10-year period, 20-year period. You might see ups and downs. That's how the market works. Any market works that way, but you're not going to see it fall off a cliff the way that the stock market is about to. So if you like what you saw today, again, like and follow. We'll talk soon.